Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex world of business filings. Today we're diving deep into the SRH Total Return Fund's latest report. And let's just say some of the numbers in here might make you scratch your head or maybe even raise an eyebrow or two. Think of it like an annual checkup for a big company, but with way more jargon and fewer free samples. Before we jump in, if you love getting clear, no-nonsense breakdowns of what companies are really saying in these documents, make sure you hit that subscribe button. And for even more insights and to chat with us about these filings, join our Discord community. Link in the description below. Let's get this decoded. This is an annual report, sort of like a report card for the SRH Total Return Fund, Inc. It covers their performance and financial health up to the 30th of November 2025. Imagine it as a detailed look at how the fund has been doing over the past year, covering everything from how much money they made to the risks they're taking. The fund itself is a closed-end management company, meaning it is a company that invests in other companies. Think of it as a big investment pool. It is what is called a non-diversified fund, which is a fancy way of saying it can put a bigger chunk of its money into just a few companies compared to a more spread out fund. This can mean higher potential rewards, but also higher potential risks. Alright, let's talk performance. For the year ending the 30th of November 2025, the fund saw a return of 9.28% on its net assets. That sounds okay, right? But here is where it gets interesting. The S&P 500 index, a common benchmark, returned a much higher 15% during the same time. So, while the fund made money, it lagged behind the broader market. They also mentioned that on a market price basis, which is how the shares are actually trading, the fund did better, gaining 13.46%. This means the shares traded for more than their underlying value, chipping away at the discount. This is the net asset value return, basically how much the underlying investments grew. It came in at 9.28% for the year. This is the return based on the actual stock price investors paid. It was a much better 13.46%. What this gap tells us is that the fund's stock price actually grew more than the value of its investments. This usually happens when a fund that has been trading at a discount starts to narrow that discount, meaning the gap between the stock price and the actual value of its holdings gets smaller. In other words, the market started valuing the fund's shares more favorably relative to what it owned. The S&P 500, a popular benchmark for the US stock market, had a strong year with a 15% return. This highlights that the SRH fund, despite its gains, did not keep pace with the overall market. This is a key point. A discount means the fund's stock price is trading for less than the value of the assets it holds. A narrower discount is generally good news for shareholders, as it suggests the market is valuing the fund more closely to its actual worth. So, while the fund itself may have underperformed the S&P 500, the fact that its market price grew faster than its net asset value means the discount shrunk, which is a positive sign. When we look at what actually made the fund's overall value go up, JPM Chase and Berkshire Hathaway were the stars. JPM Chase added over 3% to the fund's total return, and Berkshire Hathaway, a massive holding, added more than 2%. These two companies were major drivers of the fund's gains. On the flip side, PayPal and Forward Air Corporation were drags on performance. PayPal alone cost the fund over 0.5% of its return, and Forward Air wasn't far behind. These were the companies whose poor performance hurt the fund's overall results. Now let's look at where the fund's money is actually parked. This table shows their biggest bets. Unsurprisingly, Berkshire Hathaway is by far the largest holding, making up a massive 37.5% of the fund's total managed assets. This is a huge concentration in one company. Next up is JP Morgan Chase, another significant chunk at 13.1%. Then we have Enterprise Products Partners, followed by cash and short-term investments at 4.4%. Microsoft is also a notable holding at 4%. The top two holdings, Berkshire Hathaway and JP Morgan Chase, alone make up over half of the fund's entire portfolio. This very high concentration is a significant aspect of their strategy. This next section, the Statement of Investments, gives us a more detailed breakdown of what the fund owns. It lists out all the individual holdings and their values. As you can see here, the vast majority of the fund's investments are in domestic common stocks, a whopping 95.27%. And here it is again, Berkshire Hathaway, valued at over $791 million. This confirms the massive stake we saw in the top holdings list. And here is JP Morgan Chase, valued at over $321 million. It really drives home just how concentrated this fund is. Interestingly, the fund also has significant senior notes, which is essentially debt. They owe over $223 million in senior notes, representing about 10% of their net assets. This means the fund has taken on debt. This statement gives us a snapshot of the fund's financial position on a specific date, the 30th of November 2025. It shows what the fund owns and what it owes. Here, the fund's investments are valued at over $2.4 billion. The cost of these investments was about $786 million. This significant difference between cost and value reflects market appreciation over time. The total assets of the fund are over $2.4 billion. This reiterates the significant amount of debt the fund carries, over $223 million in senior notes. This is a substantial liability. After all liabilities are accounted for, the net assets belonging to the shareholders are about $2.2 billion. This statement shows the fund's income and expenses over a period. In this case, the year ended the 30th of November 2025. It is like the income statement for an investment fund. The fund earned a net investment income of just over $2.5 million. This is the income generated from its investments after deducting some expenses. The fund also made a significant realized gain from selling investments, totaling over $66 million. This means they sold some holdings for more than they paid for them. On top of that, the fund saw an unrealized gain of over $105 million. This is the increase in value of investments they still hold, on paper at least. Putting it all together, the fund's net assets increased by over $174 million due to its operations. This is a strong operational result driven by both realized and unrealized gains. This statement shows how the fund's net assets changed over time, comparing the year ended the 30th of November 2025 with the previous year. Notice how the net investment income dropped significantly from over $8 million in 2024 to about $2.5 million in 2025. This is a considerable decrease in income from the fund's holdings. However, the realized gains from selling investments more than made up for the lower investment income. They had over $66 million in realized gains in 2025, a big jump from the previous year. The unrealized gains, the increase in value of holdings still owned, also increased substantially, showing a positive market trend for the fund's portfolio during 2025. Despite the lower investment income, the strong gains from selling investments and the overall appreciation of their holdings resulted in a substantial net increase in assets of over $174 million for 2025. The fund paid out over $63 million in distributions to its shareholders during 2025. This is a significant amount, and it primarily came from these realized and unrealized gains. This statement tracks the actual cash coming in and going out of the fund. It answers the question of where the cash is really coming from and going to. The starting point is that big increase in net assets from operations we just saw, over $174 million. The fund spent over $155 million buying new investments. This shows they are actively managing their portfolio, and they sold securities for over $237 million. This indicates a good amount of trading activity. After all the buying, selling, and other operational cash movements, the fund generated about $63 million in net cash from its operating activities. This is largely driven by the distributions they paid out. Now, let's look at some key metrics per share. This section distills a lot of information into easy to digest per share numbers. The net asset value per share at the end of the period was $23.11. This is the underlying value of each share of the fund. However, the market price of each share was only $18.27. That is a significant difference, meaning the fund shares were trading at a discount to their actual value. This confirms the NAV return we saw earlier, 9.28%. And again, the market price total return was much higher at 13.46%. This difference is important because it shows shareholders who bought or sold at the market price actually did better than the fund's underlying performance would suggest, because that discount narrowed. The fund's operating expenses were about 1.42% of its average net assets. This is the cost of running the fund, including management fees. This section is where the real deep dive happens, explaining all the accounting details and policies. SRH Total Return Fund, Inc. is a non-diversified closed-end management company. That means it is a company that invests in other companies, and it is structured in a way that allows it to invest a larger portion of its assets in a limited number of issuers, which we've already seen with Berkshire Hathaway. This note explains how they value their investments. For stocks traded on major exchanges, they use the last sale price. For less liquid assets, they have procedures to determine fair value. This is important for understanding how their assets are valued on paper. Level 1 assets are valued using straightforward, readily available market prices. Most of their common stocks fall into this category. Level 2 involves more complex valuation using observable market data, but not direct quoted prices for identical assets. They mention their senior notes are categorized here. Level 3 assets are the trickiest, valued using assumptions that aren't directly observable in the market. This category is typically used for harder to value assets. For this fund, it appears they have no level 3 investments, which simplifies things slightly. This table shows that almost all of their investments, over $2.4 billion worth, are valued at level 1, meaning they are based on readily available market prices. This is a good sign for transparency and easy valuation. This note discusses the fund's use of derivatives, like options. They might use these for hedging, to reduce risk, or to try and boost returns. They have written options, meaning they've sold options contracts. These are valued at over $10 million. This means they've taken on an obligation, and if the market moves against them, they could face losses. This is a way the fund can generate some income, but it also introduces risk. This section details the fees paid to the companies that manage and administer the fund. Parallel Advisors LLC is the main investment advisor, charging a fee based on the fund's assets. It is 0.90% on the first $2 billion and 0.80% for anything over that. Then there is SRH Advisors, acting as a sub-advisor. Parallel pays SRH, not the fund directly. SRH gets 0.77% on the first $2 billion and 0.68% above that. So, the total advisory fees are a combination of these and other costs. This is a crucial part explaining the risks related to the fund's investment strategy, especially its non-diversified nature. They reiterate that they are a non-diversified fund. This means they can invest more in a single company. Normally they have limits, but they highlight that a single investment cannot exceed 25% of total assets at the time of purchase. This is a direct contradiction to the rule they just stated. As of the 30th of November 2025, they held more than 25% of their assets in Berkshire Hathaway. This is a significant point. They explain it away by saying this concentration is a direct result of market appreciation since the time of purchase and a reorganization. However, holding over a quarter of your fund in one single company, especially one as closely watched as Berkshire Hathaway with its upcoming leadership change, is a major concentration risk. This is a massive deal. Warren Buffett, the legendary investor, is stepping down as CEO. The report acknowledges this leadership transition at Berkshire Hathaway and the uncertainty it brings. This adds another layer of risk to their already concentrated position in Berkshire. This note goes into detail about the fund's borrowings. The fund borrowed a massive $225 million through senior notes. This is a significant amount of leverage which amplifies both gains and losses. These notes were sold directly to big investors and aren't traded on public markets, making them less liquid. The notes have different maturity dates and fixed interest rates ranging from 2.62% to 2.87%. This means the fund has a fixed cost of borrowing that it needs to cover with its investment returns. For example, one series of notes with a principal of $85 million had an estimated fair value of around $74.8 million. This difference indicates the market value of these notes has changed since they were issued. This section highlights changes and provides context on the fund's strategy and risks. The fund can use leverage up to about a third of its total assets. They currently use it through borrowings like these senior notes. This table shows how leverage can impact the fund's returns. When the market is good, leverage can boost returns. But when the market is bad, it can magnify losses. For example, if the fund lost 10% on its investments, leverage could push the share return down by over 11%. This highlights the double-edged sword of using borrowed money. This part introduces the people in charge of the fund. We see Thomas J. Moore, who used to be a CFO and a partner at Ernst & Young. He joined as a director in 2023. Stephen K. Norgard, an attorney, serves as the chairman of the board. He has been a director since 2011. Jacob E. Hemmer, who is also a portfolio manager for SRH Advisors, is an interested director. Nicole L. Murphy is a Class I director and is also the president of the fund. She is also a chief compliance officer for SRH. Jacob Hemmer is the portfolio manager for the fund. He is responsible for the day-to-day management. He is also a portfolio manager for other accounts. And importantly, he has a deferred compensation agreement tied to the fund's net asset value. The portfolio manager, Jacob Hemmer, owns between $50,000 and $100,000 worth of the fund's shares. This shows a personal stake in the fund's performance. This section talks about the portfolio managers. Jacob Hemmer is indeed the main portfolio manager, working with sub-advisor SRH Advisors. Jacob Hemmer manages nearly $49 million in other registered investment companies and over $767 million in other accounts. This means he is managing a large amount of money across different investments, which can sometimes lead to conflicts of interest. This is about the fees paid to their auditor, Cohen and Company Limited. The audit fees were consistent at $35,000 for both 2024 and 2025. Tax preparation fees were also steady at $8,500 for both years. These seem like reasonable fees for an audit firm working with a fund of this size. This section details the fund's rules for voting on the shares of companies they own. They mention their policies are available on their website and on the Sexi's website. Basically, they have rules about how they vote proxies, which are votes cast at company shareholder meetings. Now, for my take on all this, the SRH Total Return Fund certainly has some interesting things going on. On one hand, their operational performance was strong in 2025, with significant realized and unrealized gains leading to a substantial increase in net assets. However, there are a few major red flags that stand out. First, the fund's heavy concentration in Berkshire Hathaway, especially with Warren Buffett stepping down as CEO, is a significant risk that could lead to a lot of volatility. Holding over 37% of your fund in one company with a major leadership change looming is a bold and potentially very risky strategy. Second, the fund uses a considerable amount of leverage, borrowing $225 million. While leverage can boost returns in good times, it dramatically increases the risk of losses when the market turns south. The report's own tables show how a 10% market downturn could lead to over an 11% loss in fund share returns due to leverage. Lastly, while the market price return was better than the net asset value return, suggesting the discount narrowed, the fact that the fund still trades at a substantial discount to its net asset value at year, and with the market price at $18.27 compared to a NAV of $23.11, means shareholders are still buying in at a significant discount. In conclusion, the fund delivered growth through aggressive investment and taking on debt. But this growth comes with very high concentration risk and the amplified risks that come with using leverage, especially in light of major company-specific events like the leadership change at Berkshire Hathaway. Investors in this fund need to be comfortable with a high level of risk. Alright, that is our breakdown of the SRH Total Return Fund's latest report. What is your take on these numbers and what they signal for the company's future? Do you think that concentration and leverage are smart moves or too risky? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribe for more deep dives like this. And don't forget to join our Discord community for more discussions. The link is in the description. Thanks for watching, and see you next time.